Assalamu alaikum. Hello and welcome to Gurukul Online Learning Network. Today I'm instructor Sheikh Mahadi. We're going to study Finance and Business, Chapter 4, Financial Statement and Analysis. So let's start first with the basic thing, financial statement. Our very basic chart of our very basic page of this chapter is going to be the financial statement, which is the main concept, and then after that, using certain elements of the statement from the, you can see the income statement, certain elements take out, and then we will operate some other different kinds of mathematical variables. So first, let's take a look at a base formation of the financial income statement. So the income statement charts look like this: account styles, then the two boxes of values or the takas. So first, it begins with sales revenue. That means the amount we sold and the money we received. That is called the sales revenue. Basically, selling money. Selling money is 1,03,500, 100,000 to 500. Then after that, we will deduct less cost of goods sold. Less, that means deduction of cost of goods sold. What is cost of goods sold? Cost of goods sold is while selling the goods that we made from our raw product, the cost that we made for selling it. Suppose the advertisement, the transportation, the freight in the industrial charges, the electricity bill, the wages, these are called the cost of goods sold combined. So sales revenue minus cost of goods sold is 70,000, which brings it down to 33,500. That is called the gross profit, which is we get from minusing the sales revenue from the cost of goods sold. Then after that, we have to take out the net profit. The main reason of an income statement is to take out the net profit at the end of every year of a company or a farm. So less operating expenses, that means we need to minus operating expenses from this gross profit, then we can get the net profit. So what are inside operating expenses and what is operating expenses? Operating expenses means the expenses that we used for our industry to make those sales to product or to operate that whole industry or that factory. The people that were included, we had to give them salary, the transportations, the insurance, whatever name. There are so many kinds of different things, but those all fall under the subcategories of these main sections. So what are the main sections? Operating activities, there goes salary. Salary of 3,800 taka. Advertisement goes 2,000. Utility expenses goes 1,200. Insurance bills 2,500, and depreciation goes 2,000. What is depreciation? All of you know these. All of these are very basic things. And depreciation is the lessening of a lessening. That means decreasing the value of an product or an amount of a good or an asset through over time. Suppose you bought a furniture 5 years ago. 5 years ago, its value was 5,000. But in this year, today, before 5 years, you bought that with 5,000 taka. But today, its value is 3,000 taka. That means 2,000 was depreciated among time, within time. That means it holds time value of money and depreciation both among themselves intertwined. So that is called basically depreciation, the decreasement of value of an asset. That is called depreciation. So depreciation expenses 2,000. Depreciation also goes inside operating expenses. So we'll add these up: 38,000, 2,000, 1,200, 2,500, and 2,000. Our total operating expenses is 11,500. So to take out the most profit or operating profit, we lessen the operating expenses. Now from that, we have to take out the operating profit. For that thing, we have to minus it from the gross profit, the operating expenses. If we minus operating expenses from the gross profit, we will get amount of 22,000, which is our total operating expenses. Expenses was 11,000, but the total operating profit is 22,000. So we need to deduct one more step, which is the non-operating expenses, which is not directly interrelated within the physical works, which is the interest expenses. For any kinds of institution or any kinds of financial transactions, we know there are most of the cases we have to pay interest or we will take interest. So that is called an interest expenses. So the interest expenses for non-operating expenses would fall 2,000. So if we minus 2,000 from 22,000, we can get a net value of 20,000, which is the net profit of this income statement. This entire whole income statement, our total sales revenue was 1,03,500 and we got the net profit of 20,000. That means 1,03,500 and 20,000. That is net profit of today. That is the basic rule or the base system of an income statement, which we will get we will take small elements from here and we will do our maths furthermore from here. Suppose we'll take operating expenses, gross profit, cost of goods sold, sales revenue, sometimes non-operating expenses, interest expenses, various kinds of things. But firstly, let's take a look at our cash pool. What's called a cash pool basically? Cash pool is describing the outflows and the inflows of the cash. While in operating activities, both give us outflows and inflows of cash. How is that? Suppose operating activities, when cash receipts or revenue exceeds cash payment, that means we get cash payment. That is called inflow. That is inflow. That's called inflow. But in case of outflows of cash, what is outflows of cash? Outflows of cash is like, in case of operating expenses, we are giving out money, which is expense. Expenditure in case of that is called the operating activities. Then investing activities, sales of plant and equipment, sales of debt and security, collection of loans to other entities. What are these? These are the outflows of investing activities. Inflows and investing activities are purchasing those are called the inflows. Purchasing of debt security, loan to other entities. So both the investing activities are altered opposite to each other in case of investing or expenses. So that means inflows or outflows. Inflows and outflows both have those financing activities. So let's look at the outflows of financing activities. Outflows are payment of dividend. That means giving a share expected amount or a certain amount of dividend to the investor. Then redemption of debt, reacquisition of equity share. Those two are totally understandable. But then insurance of debt, insurance of equity. Those are called inflows. Inflows of cash. Issuance of equity and issuance of debt. Issuing a debt and issuing the equity, which is the main capital of the business. So we will follow these two, this cash pool and the income statement behind me. We'll follow these two for our next lessons in our math. If you have any kinds of questions regarding this lesson, please let us know down in the comment box below and be with Gurukul. Thank you.